perspective, the Fed has pretty much come out and said they're on hold for the foreseeable future. And, the specter of lower rates for longer, how does that sort of impact you as you think about the portfolio, from a, from an
I mean, we have like conflicting concerns with that, because one of the things we've been spending more time on is what's the potential for weakening of the US dollar, and not near term, but sort of midterm, longer term inflation. And we've been spending time doing a lot of analysis around that and thinking about, well, what's in our portfolio, how is our portfolio positioned to deal with that if that were to happen. And so with the Fed coming out and saying, well, we'll let inflation ride a little bit, we've got to factor that into the thinking as well, and say, well, what does that then how does that even further complicate things? So I think we're doing, I've said this recently to somebody else, like we're very, very happy with the bulk of our portfolio. We're not looking to do any major changes because we're investing for the long term. But I think if we could find, if we decide and we talk to our committee, because they ultimately make the decision on risk in terms of portfolio level risk. One of the things that I'm laying out for the next committee meeting is this concept of we probably don't have much protection for a weakening US dollar and longer term in higher inflation. And so are there things that we can do around the margin to add some protection?
Kathleen, if I can jump in there, Kathleen, I agree with that. A lot of folks, I think, are downplaying inflation coming back, but U.S. tips right now are pricing in inflation. And when I think of various themes, that's one of the themes that I have as well. And so overweighting, inflation-linked bonds and gold at the expense of the nominal government bonds.
Right.